You know how sometimes you hear about these investment strategies, these rules of thumb that seem almost too simple, like buy low, sell high?
Yeah, the classics.
Well, what if there was something even more fundamental, a really consistent pattern, almost like a whisper in the market that people have seen for decades?
Okay, I think I know where you're going with this.
It's this idea that value stocks, those often overlooked, maybe less glamorous companies, they've historically given investors better returns than their flashier, high-growth counterpart.
Value premium.
Right.
It's a big one.
Exactly, the value premium. And for a long time, it's been one of the most, well, enduring and really hotly debated puzzles in finance.
And what's truly fascinating here is that for quite a while, the consensus, or at least a very popular view among researchers, was that this premium wasn't really about risk.
Really? They thought it wasn't risk.
Yeah, many prominent studies argued value just wasn't inherently riskier. Some even suggested, it offered some downside protection. But our deep dive today, it focuses on this really pivotal paper by Relitsa Petkova and Lu Zhang from the Journal of Financial Economics.
Okay, Petkova and Zhang.
And their work, it fundamentally re-examines the whole definition of risk in this specific context. And, well, by doing that, they managed to turn some of those long-held conclusions kind of completely on their head.
Wow, okay. So what's our mission today then?
Our mission is to really unpack their innovative approach, look at their surprising findings, and figure out what it truly means for how we, as investors or just observers of the market, should think about this whole relationship between value and growth.
Absolutely. And this deep dive, it's not just for finance pros or academics, right?
No, not at all.
If you're someone who's just inherently curious about these foundational debates in economics, maybe you want to understand how markets truly work, beyond the headlines.
Or even just what makes an investment risky in the first place.
Exactly. Then this deep dive is definitely for you. We're going to try and take these complex ideas and really distill them into clear, hopefully actionable insights.
Giving you a genuine shortcut, maybe, to being truly well-informed on this really captivating topic.
Okay, let's embark on this journey then. Let's really dig into the core of this value premium. So before we can really unravel this mystery and appreciate what Petkova and Zhang did, we probably need to make sure we're all on the same page.
Good idea. Definitions first.
These terms, value stocks and growth stocks, they get thrown around all the time, right? But what actually defines them? What really distinguishes these two approaches?
That's a crucial starting point. So at their core, value stocks, they're typically mature, pretty well-established companies, and the market often perceives them as being, well, undervalued.
Undervalued, okay. Like hidden gems.
Sort of. They're like the quiet workhorses of the economy, maybe. A common way to identify them is a high book-to-market ratio.
Book-to-market. Can you break that down quickly?
Sure. It just means their book value, basically. The assets on their balance sheet minus liabilities is high compared to their current stock price, their market value.
Got it.
Think of them as solid, tangible businesses. Maybe slower growth, but perhaps more predictable earnings. Often paying dividends, but not necessarily generating huge headlines or, crazy stock price jumps.
So often overlooked, less glamorous.
Exactly. And they tend to trade at lower price multiples compared to their earnings or assets.
That's pretty clear. So if those are the dependable workhorses, what about the other side? What about growth stocks?
Right, growth stocks are kind of the opposite in many ways. These are companies, often newer, maybe in rapidly expanding industries, and they're expected to grow their earnings and revenue much, much faster than the overall market.
High expectations.
Very high expectations. They typically have low book-to-market ratios. Their market price is significantly higher than their book value, and that reflects those high investor expectations for future earnings potential.
These are the headline grabbers, then.
Usually, yeah. They generate a lot of buzz, capture headlines with innovation, promise explosive future expansion. They often reinvest most of their earnings back into the business to fuel that growth.
So maybe fewer dividends?
Often, yes. Fewer dividends, and their stock prices can be quite high relative to their current output because investors are essentially betting heavily on that future growth actually materializing.
I sometimes think of value stocks like a solid, dependable, older car model. Maybe not the flashiest, right? But it reliably gets you where you need to go, often at a good, sensible price. Its history, performance is pretty consistent, represents a tangible asset.
That's a good analogy.
And growth stocks. That's like the brand new cutting-edge electric vehicle. All the bells and whistles, loads of excitement, huge future potential.
but with a much higher price tag relative to what it does today.
Exactly. You're buying into the dream of what it could achieve. And in their paper, Petkova and Zhang, they use definitions that line up with these standard measures, right? Like Fama and French's approach.
Yes, they often employ variations of the FAMA and French HML strategy. HML just stands for high minus low book to market.
Okay.
So they essentially create portfolios of stocks with high book-to-market ratios its value and low book-to-market ratios its growth, and then they just look at the difference in their returns over time.
Yeah.
And this HML strategy, this comparison, brings us right to the core observation that really ignited this whole debate: the value premium.
The premium itself.
Right. And this isn't just, a fleeting market anomaly. It's a phenomenon that's been documented for decades. Really prominent researchers have found it again and again.
Like who?
Well, studies going way back to Rosenberg, Reed, and Landstein in 1985, and maybe most famously by Fama and French in 92 and 93.
Yeah.
They consistently showed that value stocks, on average, have earned higher returns than growth stocks.
Over long periods, right. Not necessarily every single year.
Exactly. Over long periods, it's a remarkably persistent pattern seen across different markets in different time frames.
So this isn't just some recent trend we've noticed. It's been showing up in the data for almost a century now.
Pretty much, yeah.
That's a powerful testament to its robustness, isn't it? What did Petkova and Zhang's paper specifically show about this premium? Did they confirm it too?
Oh, absolutely. Their paper strongly reaffirms this historical trend. If you look at Table 1 in their paper, which aggregates data across their whole sample period, January 1927 to December 2001.
That's a long time. 75 years.
A very long time. And the evidence is quite compelling. The HML portfolio, the value minus growth one, generated an average return of 0.39% per month.
0.39% per month. Okay, it doesn't sound huge maybe, but...
But compound that over 75 years, it translates into a really substantial difference. And what's even more striking is when they look specifically at smaller companies.
The small caps.
Right. The HML's portfolio, which represents the small stock value premium, actually delivered an even higher average return, 0.89% per month.
Wow, almost a full percentage point per month for small cap value. That is a significant difference, especially compounded over all those decades.
It really is.
It truly underscores why this isn't just some quirky academic finding stuck in journals. It has profound real-world implications for investors, for portfolio managers, for everyone.
Absolutely.
I mean, if you could reliably get those kinds of higher returns from a specific type of stock without taking on genuinely disproportionate risk, wouldn't you, as an investor, want to know precisely why?
That's the million-dollar question, isn't it?
Which leads us directly to the great foundational debate here. Is this premium just a reward for taking on more risk? Or is it something else, like a result of some market inefficiency or maybe irrationality?
Precisely. This value premium has basically served as a central battleground for two fundamentally opposing views in finance. It's fascinating.
Okay, lay them out for us. View number one.
On one side, you have the risk hypothesis. This is the rational explanation rooted in traditional finance theory. It argues that the higher average return you see in value stocks is simply fair compensation for taking on more risk.
Makes sense. Higher return usually means higher risk.
The core idea is that value stocks are somehow inherently riskier than growth stocks, especially during quote-unquote bad times, economic downturns, recessions, things like that.
Okay, why riskier then?
Because in those periods, investors are most sensitive to risk. Their marginal utility for wealth is highest, meaning an extra dollar means a lot more when times are tough. So they demand higher compensation for holding assets that might perform poorly right when they need the money most.
So value stocks should theoretically do worse in downturns.
According to this view, yes, or at least be more sensitive to those downturns. They should have higher betas, higher sensitivity to market movements, specifically when the price of risk in the economy is elevated.
Okay, that's the rational risk story. What's the alternative?
The alternative is the behavioral hypothesis. This one suggests the market isn't always perfectly efficient, that this premium actually arises from systematic mispricing, driven largely by investor irrationality or, cognitive biases.
Human psychology messing things up.
Basically, yes.
Oh.
The argument here is that investors tend to overreact to past news and trends. They might get excessively optimistic about those high-flying growth stocks, driving their prices up beyond their fundamental value, making them overvalued.
Okay.
And conversely, they might become overly pessimistic about struggling value stocks, pushing their prices down below their intrinsic worth, making them undervalued.
So this mispricing creates an opportunity.
Exactly. It creates a persistent opportunity for patient, rational investors to profit as these prices eventually, hopefully, correct over the long term. Buy the undervalued, maybe short the overvalued.
Right, so it's risk versus mistakes, essentially.
If we connect this to the bigger picture, this debate isn't just academic. It really lies at the very heart of how we understand financial markets. Is the market truly efficient? Does all available information get instantly reflected in prices, and are returns purely risk-adjusted?
Or,
Or are there systematic human biases, psychological tendencies that create these persistent anomalies and opportunities? The value premium is a major battleground for these two viewpoints.
and before Petkova and Zhang came along, which side was sort of winning this debate?
Well, that's the interesting part. Before their work, the behavioral argument had actually gained significant traction. A lot of prominent studies.
Like who? You mentioned some earlier.
Yes, studies by Lakonishuk, Schleifer, and Vishny, often called LSV back in 1994, also DeBont and Theller in 87, and Chopra, Lakonishuk, and Ritter in 92. They presented really compelling evidence suggesting that value stocks don't actually expose investors to greater downside risk.
Wait, they found value wasn't riskier?
Some studies even suggested value portfolios offered better protection during market downturns.
Better protection and higher returns.
That's what the evidence seemed to show, which led many to conclude that mispricing, not genuine risk, had to be the primary driver of the value premium. It looked, for all intents and purposes, like a free lunch.
Higher returns with less risk when it mattered most.
Yeah, that does sound like a free lunch.
Yeah.
Okay, so that sets the stage perfectly for why Petkova and Zhang's work was so important. And that's exactly where the story gets really intriguing, isn't it? Because for a long time, like you just said, the conventional wisdom was pretty clear. Value isn't riskier. These early, really influential studies seem to consistently show this. Could you maybe elaborate a bit more on what those findings actually claimed and, how they reached those conclusions?
Certainly. Studies like LSV, Lakonishuk, Schleifer, and Vishny 94 were particularly influential here. They set out to examine how value and growth stocks performed in different market states. But critically, and this is the key part, they defined good and bad market states by looking at realized market excess returns. Realized returns, meaning just what the market actually did, like up months versus down months.
Exactly. Simply looking at what the market did in a given period. And what they reported was quite striking at the time. They found that value betas, the sensitivity of value stocks to market movements, were higher than growth betas in periods of positive market returns. Good times, according to their definition.
Okay.
But lower than growth betas in periods of negative market returns. Bad times.
Lower betas in bad times, so less risky when the market went down.
That's what their data suggested. Value stocks actually performed better, or at least declined less, than growth stocks during market downturns based on their analysis.
Wow. Okay, that was a really powerful argument. I mean, imagine being told that an investment strategy that historically gives you higher returns also protects you more effectively during market downturns.
It sounds almost too good to be true, doesn't it?
It really does, like a genuine free lunch for investors. And I can see now why the behavioral explanation emphasizing systematic mispricing due to, investor psychology became so popular and widely accepted.
Absolutely.
If value stocks truly had lower downside risk and consistently delivered higher returns, well, then it couldn't possibly be a risk premium, could it? It simply had to be irrational market behavior creating these mispricings.
That was indeed the prevailing logic for quite some time. LSV, for instance, explicitly concluded that value strategies do not expose investors to greater downside risk. And this wasn't just LSV. And it's ending this earlier work on the reversal effect, which is sort of an earlier manifestation of what we now call the value premium.
Reversal effect, like stocks that went down bouncing back.
Exactly. Losers becoming winners. DeBont and Thaler in 87 and Chopra et al. In 92 found similar evidence. They suggested that portfolios of loser stocks, which we now equate pretty closely with value stocks, actually had lower betas in down market periods and higher betas in up market periods.
So again, less risky when things were bad, more sensitive when things were good.
Yes. This combination was viewed as particularly attractive and not at all indicative of higher underlying risk. So, yeah, the stage was really set for behavioral finance to explain away the value premium as a market inefficiency.
Okay, so that was the established consensus. Value isn't riskier, maybe even safer in downturns. But this is exactly where Petkova and Zhang come in and introduce what turns out to be a truly critical flaw in all these earlier studies. how they actually measured good and bad times.
Precisely. This is the linchpin of their argument.
Let's really unpack this because it's subtle, but it seems profoundly important. Thinking about it, using the realized market return to define economic states.
Yeah.
It's a bit like driving a car and only looking in the rearview mirror to understand the road ahead.
That's a brilliant analogy. Perfect.
It tells you what already happened. Is that truly the most accurate or insightful way to capture the underlying economic conditions or, more importantly, the expected risk and investors facing moving forward?
That's exactly the question Petkova and Zhang asked, and their answer was a resounding no. They argue that previous studies, including LSV and the others, made a fundamental, maybe understandable but critical error by defining good and bad economic states based solely on realized market excess returns.
Just the outcome, not the context.
Right. The core problem, as they highlight, is that the realized market return is, in their words, a noisy measure of aggregate economic conditions, or maybe more specifically, of investors' marginal utility, how much they care about an extra dollar.
Noisy, meaning it doesn't accurately reflect the underlying state.
Exactly. It's an ex post observation. It's what happened after the fact, a historical outcome. It's not necessarily an anti-expectation of future economic states or the perceived risk at that time.
So let's say the market had a fantastic month, up 5% or something. Previous studies would just call that a good time. But Petkova and Zhang are saying, hold on a minute. Just because the market went up doesn't mean the underlying economic environment felt secure or that future risk expectations were low for investors. It could have been, I don't know, a relief rally in the face of deep uncertainty.
Precisely. That's the ex post versus ex ante problem, and it's absolutely central to their entire argument. What previous studies labeled as good states ex post periods with high realized returns could, in reality, have been bad states ex ante.
How so?
Well, they could have been periods where the expected market risk premium was actually very high, maybe because of underlying economic weakness, significant uncertainty, a high perceived price of risk. Investors were demanding a high return because things felt risky.
And the market just happened to deliver it that month.
Right. And conversely, an ex post bad time, like a market downturn, might have followed an ex ante period where expected risk was actually relatively low.
So the link between what happened and what was expected is weak.
Very weak. Petkova and Zhang report the correlation between realized and expected market returns in their full sample is only about 0.11.
Wow, that's low. Basically noise.
Pretty much. It's far too weak to make realized returns a reliable or accurate proxy for the expected level of risk or the underlying economic state that truly drives an investor behavior and risk aversion.
So it raises this fundamental question. Are we measuring risk when it truly matters? When people talk about bad times in the context of financial risk, they usually mean periods of high uncertainty, right? Economic contraction, maybe, when the market's collective fear dial is cranked way up.
Exactly that. A realized market downturn can certainly reflect those bad times, but it might not be the most precise predictor or indicator of the fundamental economic state that drives an investor's aversion to risk in the first place. What matters is the expectation of bad times ahead. Hashtag 2.3, introducing expected market risk premium as a superior measure.
Okay, so if looking in that rearview mirror, focusing only on realized market returns, isn't the best way to understand economic conditions and risk perception, what's the alternative? How do Petkova and Zhang propose we should more accurately measure these good and bad economic states, especially from that forward-looking ex-ante perspective?
They propose using a far more precise and crucially forward-looking measure, the expected market risk premium.
Expected market risk premium.
Instead of merely observing what the market did, they shift the focus entirely to what the market is expected to do in terms of returns and maybe more critically, what the perceived level of risk is in the economy at any given moment.
That feels much more intuitive, doesn't it? Trying to capture the market's state of mind.
It really does. It attempts to capture that collective sense of future uncertainty, of risk appetite.
But how do they actually go about measuring this expected market risk premium? It feels a bit abstract. How do you quantify market expectations and risk perceptions before the fact?
It's actually a brilliant application of existing financial tools and data. They estimate this premium using a set of well-known, widely accepted conditioning variables, sometimes called instruments.
Conditioning variables. What are those?
They're basically publicly available economic indicators that are known before the returns happen, and they act as proxies for economic health, investor sentiment, and future market expectations. They aren't just pulled out of thin air. They're standard in the time series predictability literature and have strong theoretical grounding.
Okay, so what kind of variables are we talking about?
They use four key ones. First, the dividend yield, DIV. That's the total dividend paid by the market over the past year divided by the current market price.
And what does that tell us?
Well, a higher dividend yield can often signal lower expected future market returns. Or sometimes it indicates that investors perceive underlying economic distress, which causes stock prices to fall relative to their payouts.
Okay, DIV. What's next?
Second, the default spread, DEF. This measures the difference in yields between riskier corporate bonds, like Bay-rated, and safer ones, like E-rated.
Ah, the credit risk indicator.
Exactly. A wider spread suggests the market perceives a higher risk of companies defaulting on their debt. This often signals worsening economic conditions as investors demand a bigger premium for holding that riskier corporate debt.
Makes sense. Third.
Third, the term spread, term. This is the difference between the yield on a long-term treasury bond, say 10-year, and a short-term treasury bill, like 1 year.
The yield curve slope.
Precisely.
Right.
Historically, an inverted yield curve where short-term rates are higher than long-term rates, making the spread narrow or negative, has often preceded economic recessions. It signals that bond investors expect slower growth or even a downturn ahead, maybe due to anticipated monetary policy tightening.
Okay, that's a classic one. And the last one.
And finally, the short-term treasury bill rate, TB itself, just the yield on a short-term T-bill. Higher short-term rates can indicate tightening monetary policy trying to cool an economy, or maybe expectations of higher inflation. Both can impact expected equity returns.
So these aren't just random variables. They're chosen because they reflect economic conditions and expectations.
Exactly. And importantly, they are consistent with modern asset pricing theories, like Campbell and Cochran's consumption-based model from '99, which predict a countercyclical expected market risk premium.
Countercyclical meaning?
Meaning the premium investors demand for taking on market risk tends to be higher when the economy is struggling and lower when the economy is booming. Which makes intuitive sense, right? You want more compensation for risk when times are bad.
Absolutely. Okay, this is really where the deep dive begins to reshape our understanding, isn't it? Because by changing how they define good and bad times, moving from just looking at past market returns to actively estimating future risk perceptions using these forward-looking indicators.
They completely shift the narrative.
It's a powerful, almost philosophical lesson, how the very tools you choose to measure something can fundamentally change your conclusions. They're really trying to capture the state of mind of the market, the expected level of risk, that collective apprehension or confidence, rather than just what already happened.
That's the core innovation.
Okay, so with this ingenious new, more refined way of looking at economic conditions, using the expected market risk premium instead of just realized returns, how did Pekova and Zhang actually design their research? How did they put this new lens to the test to really examine the relative risk of value and growth stocks?
Well, their research design was quite sophisticated, actually, and pretty robust. They used a sort of two-pronged approach.
Two prongs, okay. What was the first?
First, they used a relatively simple sorting procedure, but crucially, using their new metric. Instead of just sorting months by market ups and downs, they sorted months based on the level of the expected market risk premium they calculated using those conditioning variables.
Ah, sorting by expected riskiness.
Exactly. This allowed them to define economic conditions much more precisely. They divided the whole economic landscape into 4 distinct states.
4 states.
Yeah. Peak represented the lowest 10% of months in terms of expected risk premium. So periods of general optimism, low perceived future risk, basically. Really good times.
Okay, peak.
Then expansion. These were months with a below average expected premium, but not quite in that bottom 10%. Still pretty good.
Got it.
Then recession. These months had an above average expected premium, but not in the highest danger zone yet. Things are looking shakier.
Recession. Makes sense.
And finally, trough. This category captured the highest 10% of months for the expected market risk premium. So areas of severe economic uncertainty, high perceived risk, likely significant investor anxiety, what we definitely call bad times.
Peak, expansion, recession, trough.
Yeah.
Defined by expected risk.
And within each of these carefully defined states, they then measured the conditional betas of the value and growth portfolios. How sensitive were these portfolios to the market in that specific state?
And how did they measure those betas?
They used 2 methods, just to be thorough. Rolling betas, calculated from 60-month moving windows, and also fitted betas derived from conditional regressions that actually incorporated the same conditioning variables we just talked about.
So multiple ways to see how betas changed.
Right. This allowed them to observe how value and growth betas dynamically behaved across these different economically precise states.
That's a really powerful approach. It's like having a high-resolution weather map of risk instead of just knowing if it rained yesterday.
Good way to put it.
Instead of just saying, oh, the market went down, that's bad, they're truly digging into the deeper economic signals, the spreads, the yields that tell us about the state of mind of the market, the expected level of risk. And then, crucially, seeing how different stocks react to those deeper forward-looking signals.
Exactly.
Okay, that was prong one. What was their second, more formal approach?
Their second approach was indeed more formal, more statistically rigorous. Beta premium regressions. These are directly motivated by the conditional capital asset pricing model, the conditional CAPM.
Conditional CAPM.
Here, the key metric they really focused on was the beta premium sensitivity, which they denote as gamma in the paper.
Gamma. What does that measure?
It measures precisely how an asset's beta, its sensitivity to overall market movements, changes in response to changes in the expected market risk premium.
So how much does the riskiness change when the perceived riskiness of the whole market changes?
You got it. And theoretically, for the rational risk hypothesis to hold water, a positive beta premium sensitivity for value stocks, or the HML portfolio, would be absolutely critical.
Why positive?
Because a positive gamma means that the stock's risk actually increases when the price of risk in the economy is higher. In other words, value stocks become riskier precisely during those bad times, defined by high expected risk premiums.
Risk goes up when risk aversion goes up.
Exactly. This dynamic, this higher risk when it hurts most, is precisely what a rational risk explanation for the value premium would predict. It would justify that higher average return.
That makes a lot of sense. If something becomes riskier exactly when you, as an investor, are most worried about the future and least able to stomach losses, well, you'd certainly expect to be compensated for taking on that kind of exposure. It's like the very definition of systemic risk, isn't it?
It really is. And to make sure their inferences were as solid as possible, they employed a pretty sophisticated econometric technique called Generalized Method of Moments, or GMM.
GMM, what does that do?
It's an advanced method that helps account for potential measurement errors, both in estimating the expected risk premium itself and in estimating the conditional betas. Getting those numbers right is tricky.
So it makes the results more reliable.
Much more reliable, much harder to dismiss as just statistical noise. They apply this whole comprehensive methodology to the standard HML, value minus growth, and HMLs, small stock value premium strategies, using those conditioning variables we outlined across their huge sample period, Jan 1927 to December 2001.
Okay. Very thorough. All right, the stage is set. We've talked about the flawed rearview mirror of realized returns, the ingenious new lens of the expected market risk premium, and these robust methodologies sorting states, beta premium regressions, GMM. Now, for the moment of truth. When Petkova and Zhang applied this innovative, forward-looking approach, what did they actually find? Did value stocks, under this more precise measure, finally reveal themselves as riskier in bad times? Or did that elusive free lunch idea, higher returns, lower downside risk, somehow manage to hold up after all?
That's the exact question they aim to answer. And the findings, well, they don't just challenge, they fundamentally overturn decades of conventional wisdom. Here's where it gets really interesting. This is the big reveal.
Okay, I'm ready.
Petkova and Zhang found that when measured correctly, using the expected market risk premium, time-varying risk does move in the right direction.
The right direction,
Meaning value betas do tend to cover positively with the expected market risk premium, and growth betas tend to cover negatively.
So value gets riskier when expected risk is high, growth gets less risky.
Exactly. And as a result, the value minus growth portfolio's beta, the HML beta, also tends to cover positively with the expected market risk premium.
Wow. Okay, so when you use the right economic lens, this forward-looking measure of expected risk, it appears value is riskier in bad times and growth is actually less so. This is a crucial distinction. It completely shifts the entire debate, doesn't it?
It really does. It's a fundamental reversal.
Can you give us some specific numbers from their results, something that really brings this finding to life?
Absolutely. Let's dig into Panel A of Table 2 in their paper. This covers the full sample, 1927 to 2001. For the HML portfolio, that's our value minus growth proxy, they found a clear countercyclical pattern for its beta.
Countercyclical, meaning its risk moves against the economic cycle.
Precisely. When the economy is strong and the expected risk premium is low, those peak times, value stocks are relatively less risky compared to growth. But crucially, when the economy sours and the expected risk premium climbs high, those trough times, value stocks actually become more sensitive to market movements. Their risk amplifies exactly when the economic environment feels weakest.
Okay, numbers. What did the betas look like?
Specifically, the average rolling beta for HML was negative 0.166 and negative 0.16 in peak states, the best times.
Negative beta. So it moved opposite the market then.
On average, yes, relative to growth in those very good times. But it dramatically shifted to positive 0.33 plus 0.33 in trough states, the worst times, defined by high expected
From
risks.
negative to positive. That's a huge swing. Is that statistically reliable?
Highly reliable. The standard error of the difference between those peak and trough betas was tiny, only 0.024. And the fitted betas showed an even more pronounced shift, an average of negative 0.33 in peak versus plus 0.40 in trough. Again, a very reliable difference. Standard error of 0.022.
That's incredibly clear. Moving from negative to quite positive, it truly highlights how fundamentally different our understanding of values risk can be, just depending on how we define bad times. For an investor, what does this dramatically shifting sensitivity actually mean? How should they think about value stocks across these cycles? Is it just higher average risk, or is there a more nuanced dynamic?
It means the risk of value stocks isn't static at all. It's dynamically linked to the broader economic climate, specifically to expectations about that climate. During periods of economic strength and low expected risk, peak times, value stocks might actually offer some relative stability or even act as a diversifier against growth, hence that negative beta. But the moment the economy turns and investors become genuinely fearful about the future, when that expected market risk premium skyrockets into the trough zone, value stocks become more sensitive to those potential market downturns. They take on more risk precisely when investors are least willing or able to bear it.
And that's why they command a premium.
That's the rational explanation, yes. They're being compensated for bearing this additional difficult-to-stomach risk during the absolute worst perceived times. And if we look at those beta premium sensitivities, the gamma coefficients from the regressions.
Yeah, the measure of how beta changes with expected risk.
Right. The picture becomes even clearer, even more conclusive. The HML portfolio, value minus growth, had positive sensitivities overall. 20.42 for the rolling beta sensitivity and 33.34 for the fitted beta sensitivity, both estimated with reasonable precision.
So higher expected risk means higher HML beta.
Yes, but to really understand the components driving this, they looked at the value H and growth L portfolios separately. And guess what? The value portfolio H had positive sensitivities, 18.63 rolling, 29.37 fitted, but the growth portfolio L had negative sensitivities, negative 1.86 rolling, negative 4.04 fitted.
Wow. So value gets riskier, growth gets less risky when expected risk goes up.
Exactly what the rational risk hypothesis would predict. It's a complete reversal of those earlier findings based on realized returns.
That is a huge overturning of previous findings. It really suggests that the whole free lunch idea was maybe just an illusion born from a flawed measurement tool.
Seems likely based on this evidence.
It underscores such a powerful lesson. If you use the wrong tool to measure risk, you're just going to get the wrong answer. But did this pattern hold true across all types of value stocks, or in different historical periods? Were there any, nuances or exceptions to this big finding?
That's an excellent follow-up question because, the real world is rarely simple. And the paper doesn't just present this one monolithic finding. They definitely delve into important nuances across different market segments and historical periods.
Like small caps versus large caps.
Exactly. For instance, the value anomaly, that value premium, is often observed to be strongest in small-cap firms. So the small stock value premium, which they represent with the HML's portfolio, small high minus small low book to market, is particularly insightful to look at.
Okay, so what did they find for HMLs? Same pattern.
Well, interestingly, in the full sample, Table 2, Panel A, HMLs didn't initially show that clear countercyclical beta pattern when they just sorted the betas into the four states. And maybe more surprisingly, its fitted beta premium sensitivity, that gamma coefficient, was actually negative 8.48.
Negative. That sounds like the opposite of the main finding for HML. That seems problematic, right? Especially since the value premium is supposed to be strongest in small stocks.
It does seem problematic at first glance, yes. It was definitely a puzzle for the time-varying risk hypothesis. If the effect is strongest where the premium is biggest, you'd expect the risk pattern to be clearest there too.
So what did they do? Did they have an explanation?
They did. They were meticulous. They re-examined the data, but this time they strategically excluded the Great Depression era, a period of truly unprecedented, unique economic turmoil.
Ah, removing the 1930s.
Exactly. When they focused on the post-depression sample from January 1935 to December 2001, which is still a very long time, shown on Table 2, Panel B, the HML's beta premium sensitivity flipped and increased significantly. Became plus 7.38 for rolling betas and a really robust plus 24.64 for fitted betas.
Wow, another dramatic reversal just by excluding the depression. What does that tell us?
It highlights a crucial insight. The Great Depression seems to have had a sizable and distinct impact, particularly on small growth firms. As economic historians like Bernanke noted back in '83, that period was characterized by unique financial factors, widespread bank failures, extremely high default rates, which disproportionately hammered smaller, more financially vulnerable firms, maybe especially the small growth ones relying on external finance.
So the depression was just different.
It suggests that truly extreme, perhaps unique outlier events, like the Great Depression, can actually skew the overall findings. And the general patterns of time-varying risk might hold more consistently in normal severe downturns rather than downturns driven by a complete systemic financial collapse like that.
That's fascinating. It's a really powerful reminder that historical context matters immensely. Sometimes these huge outlier events can actually mask underlying patterns that are more broadly applicable. We have to be so careful about drawing conclusions from periods that are fundamentally unique. So the overall trend of values time-varying risk seems clear, but its strength, maybe even its direction in extreme cases like small caps during the Depression, can be influenced by the specific economic landscape. Did they look at any other notable periods, maybe more recent times?
Yes. They also closely examined the post-Compostat sample. This period typically starts around January 1963 and runs to their end date of December 2001. Table 2, Panel C. This is a period finance researchers often focus on because we have much better, more detailed firm-level accounting data available from the Compostat database.
Right, the modern data era, relatively speaking. So was the evidence stronger or weaker then?
Interestingly, in this more recent period, the evidence for time-varying risk was generally weaker compared to the broader post-depression sample.
Weaker? How so?
For the main HML portfolio, the fitted beta premium sensitivity dropped quite a bit, from around 25 down to about 10. For the small cap HMLs, the rolling beta sensitivity also declined, although the fitted beta sensitivity for HMLs actually remained pretty significant, still around 21.
That's quite a drop in the strength of the signal for the main HML. Why would the evidence for time-varying risk be weaker in this more recent, heavily studied period? That feels almost counterintuitive if this effect is truly fundamental to the value premium.
Yeah, it does seem a bit odd at first. Petkova and Zhang carefully consider why this might be the case, and they offer a few compelling potential explanations. Each adds another layer to the story.
Okay, like what?
One, they suggest this period might genuinely reflect increased investor overreaction in recent decades. Maybe the behavioral arguments, like those from Lokonoshok et al., have more weight in this specific time frame. Think about the dot-com bubble, for example, or other periods of maybe irrational exuberance. Perhaps investor sentiment and behavioral biases played an amplified role then, temporarily obscuring some of the underlying rational risk dynamics.
So maybe human psychology did become a bigger factor later on.
It's a possibility they acknowledge. A fascinating thought, are there periods where psychology temporarily overwhelms pure economic rationality? Two, they also echo a point made by Fama back in '98, that this post-1963 sample, while frequently studied because of the data, might just be too special or short for standard inferences.
Too short. It's still almost 40 years.
True, but compared to the 70-plus years of their full sample, or the nearly 70 years post-depression, a shorter data window can sometimes mask long-term trends or just make statistical inferences less robust. Things can look different over shorter horizons.
Okay, fair point. Any other reasons?
Yes, and this might be the most critical one. This post-63 period had a relatively small number of recessions, or troughs in their terminology, compared to earlier periods.
Fewer bad times in the sample?
Exactly. They identified only 6 troughs, those periods of highest expected risk, across the 39 years, from '63 to '01. Compare that to 6 troughs in just the 29 years between 1935 and 1963, excluding the Depression.
Wow, half as frequent, roughly.
Right. And if these cyclical fluctuations, especially the really bad times, are the very engine driving this time-varying risk, particularly the downside risk we care about,
Then if you have fewer bad times in your sample.
it's logical that the evidence would just appear weaker. You haven't observed the phenomenon as many times. As they put it, if cyclical fluctuations are the driving force, then the evidence is perhaps supposed to be weaker after 6 out of the 12 recessions are removed from the sample.
That makes a lot of sense. It's like trying to study hurricanes but only looking at data from a decade with unusually calm weather. You just won't see the pattern as clearly.
Precisely.
Okay, so it's a powerful illustration of how the specific conditions of your sample, the historical period you choose, can really influence your conclusions, even when you're looking for a fundamental effect. So while the overall trend of time-varying risk seems pretty clear now, the strength of that signal can certainly vary. But this brings us back to a crucial question. Even if value is demonstrably riskier in bad times, and we've shown that the risk moves in the right direction, does that fully explain its historically higher returns? Is the amount of risk enough? Or is there still something left over?
That's precisely the next critical step in their analysis. And it's where the story takes another really important turn. Because, okay, even if we firmly establish that time-varying risk for value stocks goes in the right direction, they are riskier when investors are most risk-averse. We still need to ask a more rigorous question. Is the amount of that risk, the magnitude of that extra sensitivity in bad times, actually sufficient to fully explain the magnitude of the value premium we observe? Can we explain the whole return difference based on this risk difference within the strict confines of traditional asset pricing models? Or is there still some unexplained component, some leftover return?
Right. Direction is one thing, magnitude is another. And when we talk about traditional asset pricing models here, the benchmark we usually use to test this is the conditional capital asset pricing model, the conditional CAPM, right? That's the standard.
Yes, exactly. The conditional CAPM is the theoretical framework they use as the benchmark for this stronger test. The core idea, just to recap, is that an asset's expected return should be directly proportional to its conditional beta, its sensitivity to the market, given the current economic conditions, which we now know varies, multiplied by the expected market risk premium at that time.
So risk sensitivity times the price of risk.
Right, so if the conditional CAPM, even with this improved understanding of time-varying risk that Petkova and Zhang uncovered, can completely explain the value premium, then there shouldn't be any unexplained excess returns left over.
Meaning the alpha should be zero.
Exactly. In technical terms, the alphas, that portion of returns the models can't explain, after accounting for this time-varying risk for these value minus growth portfolios, HMLs, should ideally be statistically indistinguishable from zero in these conditional market regressions. If the model works perfectly, alpha is zero.
Okay, so that's the crucial test. If Petkova and Zhang's refined risk measure truly reconciles the value premium with a rational model like the conditional CAPM, then those alphas should vanish, or at least become statistically insignificant. What did they find? Did the numbers finally add up? Did the alphas go away?
This is a really big finding, and it reveals the limits of even this sophisticated approach to risk. They found that while controlling for time-varying betas generally did reduce the alphas of the value minus growth strategies compared to simpler models that ignored time-varying risk.
So it helped somewhat.
It helped, yes. The alphas got smaller. But, and this is the key part, these alphas remain positive and mostly significant. This is their key finding number 2. The magnitude mismatch.
Magnitude mismatch.
Okay. Well, the direction of the risk is now consistent with a rational explanation. Value is riskier in bad times. The amount of that risk simply isn't large enough, according to the conditional CAPM, to fully account for the observed returns. There's still leftover alpha.
Wow. This is a really powerful insight. It's like finding a leak in a dam, patching it perfectly based on your best understanding, and then realizing the reservoir is still draining faster than it should be.
That's a great way to think about it.
The direction of risk is right. We fixed that leak. But the amount of risk doesn't fully account for the higher returns value investors are getting. This isn't just a small quantitative discrepancy. It feels like it opens up a fascinating crack in our understanding. What does this persistent unexplained alpha actually tell us? Does it mean the conditional CAPM, even with these sophisticated refinements, is still missing crucial pieces of the puzzle? Or are we maybe back to considering an element of persistent market inefficiency, perhaps driven by human behavior, even after accounting for these better risk measures?
Exactly, and that's why this paper is so pivotal. It really moved the goalposts for both sides of the risk versus behavior debate. It's not a clear win for either side anymore. To give you a concrete example of those remaining alphas from their Table 3, for instance, in the full sample period, 1927-2001, the small stock value premium, HMLs, still had an alpha of 1.10% per month, even after accounting for time-varying betas in the conditional regressions.
Over 1% per month unexplained, that's huge.
It's highly significant, yes. The standard error was only 0.20%. Even in the post-depression sample, 1935-2001, which might be cleaner, HML's alpha remained substantial at 0.95% per month. Again, highly significant with a standard error of 0.17%.
So while the alphas were maybe lower than if you ignored time-varying risk completely,
They were definitely lower than the unconditional alphas reported back in Table 1, yes. Accounting for time-varying risk did explain some of the premium. But these remaining conditional alphas are unequivocally statistically far from zero.
meaning the conditional CAPM, even with this much more accurate lens for risk, simply cannot fully explain the robust profitability of these value strategies. The model still comes up short, hashtag tag 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 4.3, what this means for explaining the value premium. Okay, so their conclusion here is quite clear. While they found risk moving in the right direction, and that itself is a monumental finding overturning previous work, it wasn't strong enough. The magnitude wasn't enough to fully explain the entire premium. The observed returns from value stocks are still just too high, even after meticulously accounting for their time-varying risk exposures within this standard model.
Precisely. That's the core takeaway from this part of their analysis. It means that positive covariance between the value minus growth betas and the expected market risk premium, while real and significant, is simply too small quantitatively to fully explain the observed size of the value premium, at least within the strict confines of the conditional CAPM framework.
Is this finding consistent with other research looking at the conditional CAPM?
Yes, it actually lends strong support to other contemporary research, like a paper by Llewellyn and Nagel from 2004. They also found that the conditional CAPM, even when you try to estimate it carefully, generally performs pretty poorly in fully explaining various well-known asset pricing anomalies, including the value premium.
So it's not just Petkova and Zhang finding this limitation.
No, it seems to be a more general problem with the conditional CAPM's ability to capture all sources of return variation. What's so fascinating here is that even with a much more accurate lens for risk, a lens that definitively shows value is riskier when it matters most, we still have these residual returns, this persistent alpha.
Which suggests
It strongly suggests that while rational, time-varying market risk plays a crucial, previously underestimated role, it's almost certainly not the sole determinant of the value premium. It's an invitation, really, to consider additional factors, or perhaps complex combinations of factors, that go beyond just market beta and its variations over time.
this is such a crucial point in the whole story. If we now know that value is riskier in bad times, but that risk exposure alone doesn't entirely explain its superior returns, what does this mean for that long-standing debate between rational risk and behavioral mispricing? And more broadly, what does it mean for a fundamental understanding of market efficiency itself? It sounds like the story isn't over, it's just become much more nuanced and complex than maybe either side initially thought.
Okay, so the findings from Petkova and Zhang, they truly challenge what was considered conventional wisdom in finance for decades, especially on the behavioral side. How exactly do their results directly contradict those previous findings that argued value wasn't riskier, and maybe even offered downside protection? Can we draw that contrast really clearly?
Yes, it's a direct head-on challenge to a significant body of prior research, and they make that challenge explicit. They directly revisit the discrepancy with studies that found value either wasn't riskier or even performed better in downturns.
Like LSV 94. Exactly. Most notably, Lakonishuk, Schleifer, and Vishny 94. The core issue, as we've hammered home, was that those behavioral studies used realized market excess returns to define good and bad times. Petkova and Zhang rigorously demonstrate, both theoretically and empirically, that these are noisy, backward-looking measures that can, and often do, misclassify the true underlying economic state.
Because what happened isn't the same as what was expected or feared.
Precisely. They stated quite bluntly in the paper, what behavioral studies classify as good states ex post tend to be bad states ex ante and vice versa in terms of business cycles. This fundamental difference in defining the underlying economic reality, the context, is the wedge that completely separates their conclusions from the earlier ones.
So if I'm getting this right, the entire logical premise for those earlier conclusions like value isn't riskier in bad times or value offers downside protection was essentially built on a foundationally flawed definition of what constituted a bad time in the first place.
That's exactly what Petkova and Zhang argue, and their evidence strongly supports it.
It's a really powerful moment in research, isn't it? When new methodology or just a more careful application of existing ideas completely flips the script on what was considered established knowledge. It's a great reminder for us as observers of the market or anything complex to always question our assumptions, especially about how we define and measure core concepts like risk or bad times.
Absolutely. And to truly drive this point home, Petkova and Zhang didn't just point out the flaw theoretically. They went back and effectively replicated and overturned the key empirical findings of other influential studies like DeBont and Thaler, 87, and Chopra et al.
92, the ones who looked at the loser stocks.
Right. Those earlier works famously found that loser value portfolios had lower down market betas, less risky in downturns, and higher up market betas, more sensitive to rallies compared to winner growth portfolios. This combination, as we said, was widely seen as an attractive combination for investors and interpreted as clear evidence that value stocks were not riskier in downturns, strongly supporting behavioral explanations based on this pricing.
Okay, so what did Petkova and Zhang do with those specific findings?
Well, in Table 4, Panel B of their paper, they reevaluated those very regressions. But instead of using the old dummy variable based on realized market returns up or down.
They used their superior approach.
Exactly. They redefined the market state dummy variable using their expected market risk premium measure reflecting good times as periods of low expected premium and bad times as periods of high expected premium, looking forward instead of backward.
And what happened? Did the results change?
The results reversed dramatically, completely flipped. When the market state was redefined using the expected premium, the HML beta, value minus growth, was found to be negative 0.26 in their redefined good times, low expected risk.
Okay, negative beta again in good times.
And a statistically significant positive 0.34 in their redefined bad times, high expected risk.
Positive beta in bad times, the exact opposite of what DeBont and Thaler found.
Precisely. This clearly and unequivocally demonstrates that value does expose investors to greater downside risk when you use the correct forward-looking measure of risk perception. It directly overturns those specific conclusions of DeBont and Thaler and Chopra et al.
That's incredible. So this provides powerful empirical evidence against that common perception in behavioral finance, the one summarized by Barbaras and Thaler in 2003, that there's little evidence that the portfolios with anomalously high average returns do poorly in bad times.
Petkova and Zhang definitively provide that missing evidence. Value does do relatively poorly, or at least becomes more sensitive in expected bad times.
That's just, wow. It's not just a subtle shift, it's a complete inversion of what was widely believed for a long time. It essentially pulls the rug out from under a core argument of the behavioral camp, doesn't it?
It certainly poses a major challenge to that specific line of argument, yes.
But okay, if this time-varying risk is indeed a rational explanation for at least some significant part of the value premium, are there any modern theoretical models out there that provide an underlying economic reason for this observed behavior? Why should value betas behave this way across cycles?
Yes, absolutely. And this is where the paper beautifully connects their empirical findings back to plausible economic theory. Petkova and Zhang point out that their findings are remarkably consistent with recent rational asset pricing models, specifically a hypothesis developed by Lu Zhang himself in a 2005 paper called the costly reversibility hypothesis.
Costly reversibility. Okay, tell us more about that. It sounds intriguing, almost like a physical constraint on businesses. How does it work?
It is, very much so. It's grounded in real-world operational realities. The hypothesis posits pretty intuitively that firms generally find it more costly and much more difficult both financially and operationally to reduce capital or scale down unproductive operations than it is to simply expand when times are good.
Easier to grow than to shrink.
Basically, yes. Think of a traditional manufacturing company, maybe one with an aging factory and lots of specialized machinery. In a booming economy, they can probably add a new production line fairly easily, hire more workers, boost output, simple expansion.
Right.
But now imagine a severe downturn hits. It becomes incredibly difficult and very expensive to shut down that factory, maybe lay off a skilled workforce you might need later, or try to sell off specialized assets that have little alternative use or market value in a recession. Those assets are costly to reverse. You're stuck with them. to some extent.
Okay, I see the asymmetry. How does this relate to value versus growth?
Well, now consider our typical value firms. As we define them, they're often older, more established, sometimes less productive businesses, often with more tangible assets and significant fixed costs like that factory. According to the costly reversibility hypothesis, in bad times, when the expected risk premium is high and the economy is struggling, these value firms are disproportionately hit
Why disproportionately?
because they're burdened by these relatively inflexible, maybe less productive assets that they can't easily shed or repurpose without incurring significant costs or losses. This operational inflexibility amplifies their risk during downturns. It makes their betas countercyclical. Their risk goes up when the economy is weak because they can't adapt easily.
And growth firms.
Growth firms, conversely, are often more nimble. Maybe their assets are more scalable, perhaps more intangible, like software or intellectual property. In good times, they invest heavily. In bad times, while they certainly face challenges, their operational structure might allow for different, potentially more flexible responses than the value firm stuck with the old factory. They might have fewer irreversible investments.
So this costly reversibility provides a tangible, real-world economic reason for why value stocks might become riskier precisely when the economy struggles and the market is most risk-averse.
Exactly. It grounds the financial observation in actual business operations and investment decisions.
That makes the finding even more compelling, doesn't it? It's
Yeah.
not just about abstract numbers or statistical correlations anymore. There's potentially a profound, real-world, operational reason rooted in how businesses themselves function and adapt to economic cycles that might explain this time-varying risk. It's like discovering the secret ingredient in a recipe that suddenly makes everything make sense.
It provides that crucial link between the financial markets and the real economy.
And it really forces us to think about how much of what we call risk in finance is truly just a reflection of these underlying business realities and operational constraints. But we also learned earlier that even with this crucial insight about time-varying risk, the conditional CAPM still couldn't fully explain the magnitude of the value premium. There was still that leftover alpha.
Correct. The magnitude mismatch.
So what's the path forward for research then? If costly reversibility explains the direction of risk but not the full magnitude of the return, what still needs explaining in this fascinating puzzle?
Indeed, that persistent unexplained alpha, even after accounting for this more accurately measured time-varying risk, is still there. And it means other factors must be considered beyond just market beta and its cyclical variation. This remaining puzzle, this residual return, opens up several really exciting and important avenues for future research.
Okay, where should researchers be looking next?
Well, one major avenue is to continue exploring other potential risk factors,
Yeah.
maybe within frameworks like the arbitrage pricing theory, APT, or the intertemporal key APM, ICAPM. Are there other common risk factors beyond just the overall market beta that value stocks happen to be particularly sensitive to?
Like what kind of factors?
Researchers like Fama and French themselves, in their famous 3-factor and later 5-factor models, explored factors like size, S&B, small minus big, and of course value itself, HML, along with profitability and investment factors. Petkova herself, in other work, explored links to macroeconomic risks. So perhaps the value premium isn't just about market risk sensitivity. Maybe it's compensation for exposure to a whole bundle of these other systematic risks that aren't fully captured by the single-factor conditional CPM.
So it could be that the CAPM, even the conditional version, is just too simplistic. The market's risk landscape is multidimensional, and value stocks are exposed to more of those dimensions.
Precisely. That's a very active area of research trying to identify and validate these other potential risk factors that drive returns. The other major avenue, of course, is to reevaluate the role of overreaction-related mispricing.
So behavioral explanations aren't completely off the table?
Not necessarily. Despite Petkova and Zhang's strong findings on the rational risk component, the possibility of behavioral mispricing, the kind championed by Lakonishok et al., and others could still play a role, it's not necessarily an either-or situation anymore.
Maybe it's a mix of both.
It's very plausible that the value premium is actually a complex tapestry woven from both threads. Rational risk compensation and an element of persistent market inefficiency driven by investor psychology, by overreaction and underreaction. Perhaps the true behavioral alpha that models try to explain is smaller than previously thought, now that we understand the risk part better, but maybe it still exists, coexisting with this now understood time-varying risk premium.
That's a fascinating possibility of synthesis.
What's really interesting here is that if we've identified one significant piece of the puzzle, the time-varying risk, and it's substantial, what other pieces might still be out there that we're missing. It truly invites a more holistic view, doesn't it? A potential grand synthesis, perhaps, of rational finance and behavioral finance insights is needed to fully crack this code.
This really means the story of the value premium isn't over, not by a long shot. It's such a testament to the dynamic nature of financial research. Every answer seems to lead to new, even more intriguing questions. This paper didn't just solve a puzzle, it fundamentally reframed it, giving us a clearer, much more nuanced lens through which to view market behavior and that intricate dance between risk and return. It really feels like a journey, not a final destination. Hashtag tag tag outro. So, wrapping this up, what does this all mean for you as someone trying to navigate the complexities of the financial world, whether you're an investor or just an interested observer? Petkova and Zhang's work really delivers two main findings that fundamentally shift our understanding of the value premium.
Right, let's recap them.
First, and this is a monumental shift, when you accurately measure economic conditions using the expected market risk premium looking forward, not backward, it becomes unequivocally clear that time-varying risk does move in the right direction. Value stocks are genuinely riskier in bad economic times.
Which directly overturns those earlier widely accepted studies that suggested the exact opposite. That's huge.
Huge. Second, and this is just as crucial, while this newly identified risk is significant, it's undeniable. It's not quite enough on its own to fully explain the entire magnitude of the value premium, at least within the traditional conditional CAPM framework. There's still some alpha left over.
The magnitude mismatch.
Exactly. Which means that understanding what makes an asset truly risky is far more nuanced and dynamic than just looking at historical price movements or simple market ups and downs. It's about anticipating economic conditions, understanding the market's collective anxiety level, and grasping how different types of companies react to those forward-looking expectations.
And consider this provocative thought. If value stocks are indeed riskier when the economy is struggling and investors are most fearful, which we now have strong evidence for, but they still consistently offer a premium that even our sophisticated models accounting for this very risk can't fully explain, what does that ultimately tell us?
Yeah, what does it tell us about investor behavior and market efficiency?
Are we, as a collective market, still somehow underpricing that true time-varying risk, maybe because of our ingrained biases or heuristics? Or is there perhaps a persistent element of market inefficiency, maybe rooted in behavioral factors, that continues to exist even with our very best analytical tools trying to arbitrage it away?
It really challenges us, doesn't it, to look beyond simple labels like value and growth, to question the established narratives, and to dig much deeper into the why behind market movements, realizing perhaps that the market is likely a complex blend of rational responses to genuine risk and these subtle, nuanced behavioral quirks.
It's probably not just one or the other.
It truly seems that way. So next time you hear about value versus growth investing, or you find yourself grappling with the concept of market risk, maybe remember this deep dive. Remember that how you define your terms, how you measure your data, especially how you think about bad times, can completely change your conclusions. Keep exploring, keep asking questions, and keep refining your understanding of the incredible and often surprising complexities of the financial world.
Well said.
We really hope this deep dive has given you a fresh perspective and maybe a powerful shortcut to being truly well informed on this fascinating and clearly ever-evolving topic.